Good morning. It's Saturday, January 30th, and I wanted to give you a quick update with regards to the PPP loan since our last Zoom meeting, which was last Friday. So a few things have come up, and I wanted to bring them to your attention because they're pretty important, mostly regarding California, and then potentially what the SBA may be looking for with regards to us, the business owners, documenting our 25% reduction in revenue to apply for and get forgiveness on the second PPP draw. So California, most of us know now that California is not conforming to the federal guidelines with regards to the PPP, the Paycheck Protection Program loan forgiveness. Now, last week, January 22nd, 2021, new legislation was introduced. It's AB 281 that declares the intent to conform California law to the federal law, allowing for the deductions of the expenses paid for with the PPP funds. So currently, right now, the Franchise Tax Board has taken the position that the income from the forgiveness of the loan will not be taxed. What they also said, though, to the extent that we've used this PPP loan to pay for expenses like payroll, maybe interest on a business loan, or rent, or utilities, those expenses will not be deductible. So for example, let's say I had a $50,000 PPP loan and my payroll expenses for 2020 were $200,000. If I used all $50,000 of that PPP loan to pay the payroll expenses, I would only be able to deduct $150,000 of payroll expenses on my California income tax return. The $200,000 that I spent minus the $50,000 PPP loan that went to pay those expenses, netting me out the $150,000. That's California. The federal government said not only is it not included in our income, we're allowed to deduct these deductions. So there's a difference between how California is going to tax the PPP loan proceeds and how the federal government is. So this new legislation, introduction of AB 281, is trying to conform California to the federal requirements that not only is it not included in our gross income, but that we are allowed to deduct these expenses. This is huge for California businesses that are suffering right now. So what we're asking our clients to do, and what you should be asking everybody else to do, is reach out to your state legislators and let them know that you are in favor of this, that they should be supporting this bill that was put out by Assemblywoman Autumn Burke. It's B-U-R-K-E. It's just a huge lifeline for businesses that have suffered here in California. And it sort of makes it a lot easier for us, the accounting world, to try to reconcile these loans for you and stuff like that. So that's the first big one. To find your legislator, you could go to findyourrep.legislator.ca.gov, and then again, reach out to them, let them know that you are fully in support of AB 281, and then share this news with your friends, because like I say, all businesses benefit in California from this. It'll help reduce our tax exposure, and it'll help free up some capital so we can keep our businesses afloat. The second big thing that came out, and this was on January 26, 2021 from the Franchise Tax Board, is they have stated that the EIDL grants, not the loan itself, but the grant, that $1,000 to $10,000 that we received, is considered taxable income in California. So when you're sitting down to do your taxes, you're going to need to let your tax preparer, whether it's myself or another firm, that you did receive the EIDL grant, how much you received, so that for California purposes, they get included in income. I'm sort of the position, though, right now, based on what I've been hearing back from people that have applied for PPP loan forgiveness, that as part of their loan forgiveness, they had to repay this EIDL grant. So for right now, I'm still considering putting it on the balance sheet as non-taxable income, because there is the thought that we may have to repay that money as part of the PPP loan forgiveness program. So that's number two. And then finally, it looks like we're starting to get some guidance from the SBA as to what they may be looking for with regards to documenting the 25% reduction that we have as business owners to qualify for the second loan the second PPP loan. So as you recall, when we're applying for the second PPP loan, if we're asking for under $150,000, we do not have to prove to the SBA at the time that we are applying for this loan that our business has suffered a 25% reduction in income. That reduction could be either documented by comparing the 2019-20 quarterlies or the end of the whole year. And so what we're hearing now is what they may be looking for as far as documenting that 25% reduction if in fact we are asking for over $150,000 PPP second draw loan. I also think this is going to apply that when we get a loan under $150,000 and we ultimately look for forgiveness of that loan, what we may need to prove or show to our bank so that they get submitted on to the SBA for forgiveness. So remember, over $150,000, we have to prove that our business is down 25% prior to getting the loan. Under $150,000, we're going to have to show to the SBA and our banks at the time we ask for forgiveness that our business suffered that 25% reduction. Again, it could be either a quarter by quarter comparison from 19 to 20, first, second, third, or fourth quarter, or it could be showing 2019 as a whole, or 2020 as a whole is down 25% compared to 2019. So some of the things that we're starting to hear is that the SBA will accept the following: audited financial statements. If you have financial statements are not audited, then what they're going to be asking you to do is you must write true and correct on the financial statement that you are providing to the bank on the first page and sign that page. Additionally, each page after that, you're going to need to initial all those pages. If your financial statements do not specifically identify which line items constitute your gross receipts, you must include a description of the items that constitute that gross receipts. So what this is basically saying is if we are a larger business and we have audited financial statements. Now, there's going to be a question. I'm going to need clarification as to what they mean by audited. So from an accounting standpoint, there's 3 levels of certifications that accountants can give with regards to financial statements. They could do compiled financial statements, which comes with very little assurance. Most enrolled agents, myself, tax attorney, and CPA firms can do a form of compilation, usually on the tax basis. The next level up is what are called reviewed financial statements. These are typically only done by mid-size CPA firms. And then we have audited financial statements, again, which are usually done by mid-size CPA firms. Reviewed and audited financial statements cost a lot of money, somewhere between $7,500 and up to get these done. So I'd like to find out what they mean by audited financial statements. Are they talking about a compiled financial or reviewed, or are they in fact talking about audited financials? So I think with regards to the financial statements, what most of us are going to do is we're going to go into our QuickBooks. We're going to print out our profit and loss. We're going to sign true and correct on the first page of that, sign that, and then initial each page thereafter. So that will constitute, from what we're seeing right now, valid evidence of a 25% reduction. The second thing that we're starting to see is that the banks may take our quarterly or monthly bank deposits. So in this case, you're going to show on the 2019 January, February, March deposits compared versus the January, February, March 2020 deposits. And if those deposits are down in 2020 by 25%, that should suffice to show your gross receipts. Now, you may need to provide within that those documents a summary of what these deposits are. So let's say I am doing second quarter 2020 versus second quarter 2019. If my first PPP loan was deposited into the 2020 second quarter financials, I'm going to need to break that deposit out for the bank to show that that is not income that should be included in calculation of the gross receipts. If you put money back into your business because it was struggling during that time, you're going to need to break those monies out on these deposits so that the bank doesn't think that that's income. And finally, the third thing that we're starting to see that we know that they will accept is your 2019 tax return and your 2020 tax return. So obviously that means you're going to have your 2020 tax return done and filed prior to using the third criteria that they're going to be using to review whether there was a 25% reduction. Again, I don't see too many businesses, at least from our client standpoint, that are going to probably be doing the year-to-year comparison 19 to 20. I think most of us are going to be looking at those quarterlies. But I just wanted to give a quick update on that because it does look like they're going to either be audited financial statements or self-attested financial statements where you're going to have to write true and correct on it, sign it. Providing your bank statements is another option, or again, the tax returns. So I just wanted to give a quick update. The two big things, again, that are the most pressing to me as an accountant, should be most pressing to you for the business, are going to be the conformity bill that went out, AB 281. So again, reach out to your legislators, make sure they understand that you need this as a small business owner. Spread the word to your friends. That's going to be huge. And then the EIDL grant, that looks like it'll be California Taxable Income. So if you have any questions, like always, please leave a comment in the section. We'll try to respond to those. Feel free to give me a call, email me, and we'll take care of your questions as quick as possible. Thank you again. I hope you have a great weekend, and we will talk soon. Bye-bye.